All right, welcome to another expert interview. Excited to have Kevin on today and talk numbers. So as always, let's jump straight into it. Kevin, why don't you introduce yourself and tell us who you are and what you do?
Yeah, I'm Kevin Gafni, run Kevin Gafni CPA. It's a CPA firm. We specialize mostly in tax and for small businesses and high net worth individuals.
Love it, man. I know we've had some great conversations. Thank you for making the time. Let's talk trends. I always like to see what's trending. So in the CPA tax space, what's trending right now? What are some hot topics?
So obviously the COVID impacted taxes a lot and impacted small business taxes. And so we got PPP, which is the Paycheck Protection Program. Also, the employment retention credit. Those two things pretty big in our industry. Also, crypto is getting bigger. So how to tax crypto, how to track all that and deal with that. And I'd say those are probably biggest things. And then we have a new tax law coming out probably by the end of the year. It's not quite nailed down yet, but that's coming up.
Love it. Well, I mean, those are some hot topics, right? When we talk about PPP and then the credits, how important is it for a small business owner to have support in navigating, the paperwork, the reconciling of that, understanding the limits, because I know it's changed on forgiveness 54 times. So
Yeah.
like how important is it that they talk to someone and actually dig through their specific scenario?
Yeah, I think if you didn't talk to a CPA, it's likely that you missed out on at least tens of thousands of dollars. For some company, it's hundreds of thousands of dollars in either the PPP, employment retention credits. So it's really important. And also, obviously, like you said, navigating it, understanding what is the max you can get, how do you get the forgiveness. There was some interplay between the PPP and C that you could maximize that. I think it's frankly going to be impossible for a business owner to navigate that themselves. And the bankers, they will help you along, but they'll probably just refer you to a CPA at some point.
Love it. Is there still an opportunity to get any of that money, or is it gone?
So the employment retention credit, you have up to 3 years to amend your payroll tax returns. So even going into next year, if you qualified, even in 2020 or 2021, you still might want to go back and take a look. It could be a pretty sizable credit. Generally, you're going to qualify if you had partial suspension in your business due to some kind of government regulation, or if you had a 20% drop from 2021 to 2019 in revenues, you might qualify for some money from the government. So it's good to take a look.
That's great. Great advice there. So, I mean, we're not that far in, and there's one takeaway, right? So if you haven't had a conversation about it for your business or your organization, then you probably need to. I know with one nonprofit board I'm on, they finally dug through it. I mean, they ended up getting like 30, 40 grand in credits. So, I mean, it's a big number, and for that organization, that's a lot.
Yeah.
Let's talk crypto because it's hot, right? So, I think it's an interesting gray space, right? So what are some tax things to think about when it comes to crypto? What are some talking points or things that people maybe should think about? Is it like stocks and investments? Is it not? Is it like, where are we at?
Yeah, so right now, as far as cryptocurrencies, like things like Bitcoin, Ethereum, Chainlink, things that are blockchains, most of those are treated just like stocks. The one difference right now is that there's no wash sale rule. So you do have the potential to kind of sell it at a loss and buy it back the next day and lock in that loss for the year. The new law does address that and may change that so that the wash sale rule will apply to cryptocurrency as well. But when you're looking at things like NFTs, those are maybe taxed as collectibles. We're still kind of waiting for guidance because collectibles are taxed differently than stocks are. So, historically, that's been things like gold coins, magic cards, things like that. If you're making money on it, those are taxed at a different rate than the capital gains rate. So I think going forward, probably NFTs will end up being taxed as collectibles, especially things that are like more like art and, not tradable currency, which kind of Bitcoin and stuff I feel is more like a security. So see.
Love it. Yeah. I mean, it's one of those things that, I think it's fun to look at and play with, right? But you got to be careful on the backside, right? Especially on the NFT world. You see all these hot topics and things where it's like, I bought this, NFT for $600 and sold it for 60 grand. And it's like, cool. What's the implications of that? And you probably need to put some of that away because you're going to get taxed.
Yeah, you're going to get taxed. And it's all on a ledger. It's not like it's impossible for the IRS to find that and track it. It might be hard right now, but more and more of the exchanges and ways, mediums of exchange are going to know your customer rules. So they're going to have your social security number. They're going to have some reporting requirements to the IRS at some point. And then at that point, it's going to be hard for you to kind of get away with it. Right now, it's kind of the wild, wild west where, it's the honesty policy. You want to report it all, you want to do your best, but at some point they will tighten it up.
Love it. So let's talk small business. So, I mean, and then we'll get into some strategy, but when it comes to just like general taxes or accounting, where are some missed opportunities that you see? What are some common missed opportunities you see when dealing with small businesses?
Missed opportunities, I'd say things like depreciation. A lot of it, though, I don't know if they're missing opportunities or if they're just kind of, you're out of bounds, you're out of compliance, and that's gonna, could potentially cause problems for you. A lot around depreciation, treatment of assets, and then kind of also how are you going to exit the business? What does it look like when you start making more money? For most of the businesses I deal with are flow throughs. I don't deal with that many corporations. So a lot of it comes down to individual tax planning and kind of how do we structure this that makes the most sense, lower your tax rate that way. So yeah, that's what I'd say.
Love it. So when you talk about that individual world, I know I get that conversation a lot where it's like the balance between, going sole pro to LLC and then LLC filing as an S corp. So can you talk through that journey? Because I think that that's a journey people need to understand.
Sure. So when you start out, if let's say your revenue is under 100, maybe under 150, and certainly your net income's under 150, the LLC or sole prop's probably going to end up about the same as an S corp for you. You're not going to get that much benefit from being an S corp. The main advantage of an S corp is that the business tax side of it, you get to split your tax. You get to pay yourself a wage, and you have some taxes called business income, and that business income gets taxed at a lower rate. You don't pay self-employment tax on it. When you're an LLC or you're a sole proprietor, all of your business is subject to self-employment tax. So that savings, as you make more and more and you split it between wages and the business income, you save a lot more on self-employment tax. Like for someone like me, where I'm the only person working, it's kind of debatable how much I can get away with saying, well, I'm paying myself a wage of, let's say, 40,000. I have business income of 200,000. Like the IRS might come back and say, don't do that. But if you actually have a legitimate business, you have employees, then a case can be made that, some of this income that you're making isn't based on your work or your work product. And at that point, you don't want to be paying self-employment tax on that income because it's business income. So that's kind of that journey. The pain point for being an S corp is you have to do an S corp tax return. So that costs money. You usually should have some legal documentation of what's going on as far as shareholders meetings and kind of the actual shares, stuff like that. So there's a cost to it, and it's a separate entity from you, but that's just something you kind of have to work through as you make more money. I think with the new law, one of the issues is the net investment income tax, which is 3.8%, is going to apply to business income as well as wages. So, or any net investment income, which is capital gains and dividends. So that's a conversation that you're going to have to work through, whether it makes sense maybe to be a corporation, which is taxed not as a flow-through entity, rather than be taxed as the S corp. So that's kind of what's coming down the pike.
Love it. That was such a good explanation, because it is something people need to pay attention to. And I think often I see it both ways, where people run into it too fast, where like you're a startup and you outlay all this capital to form this S corp to start or form a C corp. But maybe you're a single startup and it's like one person, you're not going to have employees for the first year. It's like, cool, I understand that from an exit strategy standpoint. If you're going to IPO or sell or bring in other shareholders, like there's a lot of reasons to do some of that stuff.
Yeah.
But on the start side, like I like that you explained, like, no, here's the process. And then you mentioned 150,000. Is that where you start to see that tipping point where it's like, you probably need to have a conversation about it?
Yeah, well, less than that, you're not going to get away with paying yourself that much less of a wage. So you're still going to pay SE tax on all your income anyway. It doesn't really make sense. And you definitely don't want to be losing money, like paying yourself a wage and then losing some money. I see some S corps like that. Your business income is negative. So then you're actually paying self-employment tax on more than you're actually making. So if you were just a sole proprietor, you'd be doing better. So you definitely want to have enough income where you can split it, where it makes sense to split it. And the amount that you're going to spend on an S corp tax return is going to be less than the amount of self-employment tax you're saving. You don't want to be again, you just don't want to be spending more money than you have to.
Good stuff, man. Yeah, I love it. I'm gonna break this part up for sure because it's one of those conversations I get in all the time where again I don't understand why someone did it, and usually it's because they didn't have a CPA or accountant, a bookkeeper, someone that they're at least trying to dig in with, and or that person gave them like general knowledge, not specific to them. So love that. When it comes to planning, especially in a scaling business, how often do you want to connect with the business and really see where the business is going? What's that journey look like with a CPA?
So I would want to be at least quarterly, I think, and probably monthly at some point, because if you are growing that fast, let's say you just have a bookkeeper and they're competent and they're reconciling the accounts, you're not going to have a good idea of where your cash flow is going to be 3, 6, 12 months from now. You talked about exit strategy. I think that's pretty crucial. And what's your real plan? Because these entity structures, on one side, you're just trying to save some tax, but on the exit side, it makes a huge difference. And also how you're going to relate to shareholders and investors, things like that. So those are conversations that need to be had pretty often, I think.
I love that. And I love that you talked about quarterly because I think, especially if you're someone who's had a 9 to 5, you've had a career, maybe you're transitioning into the entrepreneur world and owning a business. You might be used to doing taxes, and that's kind of your experience with money every year. And on the individual level, it might be fine, right? Especially if you're not high net worth, that might be perfect. If you don't have a crazy estate, multiple properties, like no problem, right? But as that starts to get more complex, you've got to have conversations because the timing on charitable contributions, and do you buy more equipment and trucks, and do you pay cash or do you finance them, and if you finance them, what's the impact? Like all these things matter, and you don't want to make the decision and then go talk to your CPA and they're like, well, had we done it 1 month later, we would have saved X dollars.
Yeah, and that happens all the time. This is one of those weird years where if the rate had ended up going up, you might want to delay a lot of those purchases, but it doesn't look like they're going to change the tax rates. So it's kind of business as usual. Like you said, take as much depreciation as you can if you had a great year, and defer some of that tax.
Love it. Well, and then play the game on so let's talk about your strategy with clients when they're trying to qualify to buy something and they're self-employed, right? Because I think this is a conversation that's critical to have with people. Is so often we're looking at, and this kind of goes to the exit strategy conversation too. We're looking to save today, so we're writing off as much as we can. We're streamlining those financials on paper, but then if you're going to look to get a mortgage or do some investing next year, that may actually be negative. So how do you navigate those conversations with people?
Yeah, so I mean, I try to stay pretty straight up. Like there at some point, don't hide any income, obviously, but as far as writing off big assets, you could produce financial statements that slow down the depreciation. You're not allowed to write off 100% of assets from an actual accounting perspective. So you could go to separate financial statements. Like a lot of people are so small, they just produce tax financial statements. But if you use GAAP, that might end up with a better net income. And I think most lenders kind of understand that if your depreciation's super high, then you can argue that was just a big piece of equipment. That was just 1 year, and this is my EBITDA. It's before depreciation. So those are things to help you kind of qualify for mortgage or qualify for what you're actually making. Show what you're actually making, I guess you could say.
For sure. So we're heading into the end of the year. So let's talk through, maybe things people could spend money on or might want to look at. Does it make sense to pre-buy services for next year? Does it make sense to buy some assets heading into the end of the year? If a business crushed it this year and is cash heavy, I know you can't give specific advice to their business, but like, is this the time to start look at spending money? And if so, what kind of items should you buy?
It's definitely a good time to at least make sure that you're on track. You also have to consider, where are you going though? If next year you're going to crush it again, and the next year you're going to crush it again, then you don't want to, maybe you actually want to take depreciation later years because you'll be a higher tax bracket. So it's something you really have to think through, but this is the time of year to really be thinking, okay, what is my income for the year? Where am I going to end up? What money should I spend or should I not spend? And how do I save it? Retirement plans, things like that should definitely be under consideration.
Perfect. How often do you get involved and talk with the financial planner, with the estate planner, or the attorney and kind of have that roundtable conversation to make sure that stuff's being allocated correctly for everybody.
Yeah, so for the clients who really have a lot going on as far as the financial planning side, I am in contact with their financial planner. We work kind of together, make sure that your RMDs are taken, make sure we're withholding enough money from your IRA if that's how we're going to pay the tax, or figuring out how tax is going to get paid. And then, on the business side, also understanding what the strategy of the financial advisor is and what they want to see from the client. I'm trying to work together to maximize opportunity for the client. What's the best strategy that's going to save them tax, not just this year, but in the long run.
That's great. Let's talk through some common just things I've heard over the years or stuff I've learned over the years. So I'll ask a bunch of questions. Maybe these will be relevant for business owners. Let's talk about cars. So if you're a solopreneur, small business, and can your car be an asset of the business? Yes or no? Like what's that look like?
It can. TikTok says it's really easy to do and you can write off 100% of it. But generally, we're going to try to allocate it based on, how much you're using it for the business. It's important that, commuting is not a deductible mileage.
So commuting is going to work and home, right?
Yeah, from your work to home. But there's ways you can make your home a place of business. Like if you have a home office there, if that's kind of a principal place of business, which means you use that for managing the company, and then you have driving between two principal places of business is deductible. So that might be something you want to look into. But as far as like a solopreneur, that's just 1040 tax return, the business is just going to deduct the mileage probably, unless you have a high-end car and you want to do a lot of record keeping, then it'll be a percentage of the use. So you might want to have one car that you use for business. That's the easiest. And then 100% of that car can be written off. And then you have a different car that you use for personal mileage, so things like that. Those are strategies.
Yeah, I like to bring that up because I know I hear often, like, I bought the car in the business. Like, well, wait a second, that's your only car. Like, did we check all these boxes correctly?
Yes.
So I like to hear that. What about phones? So I know that's a conversation we have, like your phone plan, can that be a business expense? Can you just shove all your phones in there and that's a business expense?
Again, like if you don't have any other phone, you probably want to say some of it's personal. As far as the percentage, I mean, up to 90% business for a lot of people who are working all the time seems completely reasonable, even almost 100% business. So it's just kind of case by case basis, and how much you're comfortable with, and also how much the CPA is comfortable with. Everyone's all over the place. Some CPAs are very aggressive. I tend to be more on the conservative side, but you can find someone out there that'll write off 100% of your phone. That's for sure.
I love that. But I asked the question because, again, I know there's no right answer, right? But it is something people need to consider, right? Like, just because you shove an expense in your business doesn't mean that it's a full 100% deductible expense. So although it may come out of your bank account, it may not look like that when it comes to tax time, right?
Yeah, so I'll usually, go through all the expenses for the year with the client, especially the ones that kind of seem a little out of bounds, country club fees, or
Hey, now those new golf clubs are a business asset. Stop.
Yeah, that's going to take some convincing on my part, but
I bought them as a gift for myself.
Yeah.
It is funny though, right? Like those are the fun things where you're like, can I not, right?
Yeah, and the conversations are usually, like you're saying, pretty fun. We're laughing about it. It's not, some people do get pretty serious about it, but at the end of the day, some stuff has to be personal and some stuff's business.
Love it. Let's talk about withholdings. I was having an interesting conversation. I do a lot of career consulting, right? People transitioning either between careers or career to a business, which is super fun conversation. I know you love those conversations as well. What I find interesting is there's often, I find, and maybe you see the same thing, people often set their deductions for their W-2 income and then like never revisit it. And they're getting these huge sums back when they file their taxes. And we're sitting here and I'm like, guys, like you could be taking $200, $300, $400, $500, $600 a month home today and using the money. And then when you file taxes, you more or less are going to break even because your withholdings are more in line with where they should be. Is that a conversation you see? Is that just the one or two off I've seen?
Yeah, so the Trump tax plan kind of did dial it in a little bit. Before the Trump tax plan, the W-2 it did seem like, or the W-4, it did seem like you ended up with a lot of refunds if you just filled it out normally. But it is something, like you said, that's a great opportunity to kind of take some cash out of it. That's the idea of the child tax credit advance that started this year, where they started sending out checks to everybody. It's like, well, you're waiting until the end of the year to get this credit, but you could just get it monthly. And for some people where it's a refundable credit and you can't really adjust your withholdings to get the refundable credit, like which is above, you pay less than zero tax, then that's really helpful for those families. So I think that is a discussion I have. Usually it's on the other end though. They don't want to, but breaking even is definitely where you want to be come April 15th. You don't want to give a free loan to the government, and you also, it's usually pretty painful to write that check. So
I love that. So, I mean, that comes down to that strategy, right? If you look back at your previous tax year, especially as your income grows, like if you're a sales professional, something you got to pay attention to, right? If your commissions start scaling up, like, and that's coming as a paycheck, like where's that at? Or if it's not, if you're, you know, a 1099 sales rep, then are you putting enough aside? And like, where's that game? Like that's when you need to talk to a CPA, because you could be getting money back today, and or maybe you should be putting more into the bucket so that you don't get smashed with a 20, 30, $40,000 bill.
yeah, it's a little painful, but it goes back to what we were saying before, where this is kind of the time to gather everything up, talk to your tax advisor, and make sure that you're on track. If you're going to owe, at least have an idea of what you're going to owe, because as your income grows, you don't get penalized usually for underpayment until you have till April 15th to pay that 20,000. But at least having a heads up around now changes your perspective on it, rather than me calling you April 10th and saying, hey, you got to write a $40,000 check. That's usually a tough conversation.
Yeah, go find the money, because guess what? It's due.
Yeah.
And the IRS doesn't care.
Yeah.
So let's talk about startups and like that kind of financial planning part when we're looking at like building our numbers and cash flow projections. I know you do a lot of that and you talk strategy with people on that end as well. So what are some common tips or things that you see missing or that you wish you would want to see if someone was trying to put those numbers together?
I guess it's just kind of getting a whole picture of the actual business and where they want to go. That's really the first conversation, is where do they want to go? What do they expect? What's their greatest hope? What's their greatest fear? Like what are the things that can really go right and wrong for the company? Because then you can kind of build those scenarios around that, and use a baseline in the middle to kind of give them some idea of what's possible, what they should strive for, what's possible, what they should be afraid of. Sometimes things go wrong, like COVID for a lot of companies was pretty much worst case scenario. Government told you to shut your business down. That's something you don't necessarily plan for, but at least if you have some reserves, you have some, some idea that things could go wrong, and that it's not all roses all the time, then it, keeps you focused on, they have the day-to-day running the business, but it gives you some peace of mind, I think, that you're going to be okay even in those bad scenarios, and then let the upside kind of take care of itself.
I like that high-low conversation, because I see that missing too, especially on the pitch side when people are like more in that pitching mindset. Like I feel like it's always roses and best case scenario, which is great from like a pitching standpoint, because the goal is to show upside, right? But when we dig into the real financials, like I want to see like, here's the minimum to break even, here's the high potential, here's our real growth, right? We're gonna do $1 million the first year. Well, depending on your industry, that might be very real. And depending on your industry, that might be something you never reach, right? So
exactly.
Like, I love to see that. And I'm glad that that's something you brought up, because you have to be real, because you don't want to have these high expectations and then find yourself in a situation where you're chasing money or you're having to sell your way out. Especially if that's not your skill set. Like if you're not the guy that's out there pounding the pavement, and now you're stuck in a situation where you got to make payroll in 3 days, like it could get uncomfortable.
Yeah. Payroll is a big one. And what's the impact going to be as you hire more people? How much can you afford to pay out in payroll? Those are, big conversations.
Well, in understanding, I'm glad you said payroll too, right? I find it's often one of the biggest expenses, right? Depending on how the business scales. You got to understand, it's not just the $15 an hour times 2,080 hours a year, right? There's taxes, there's withholdings. Are you going to offer benefits? If you're going to offer benefits, what are the credits on that versus what's the cost on that? Like we could be talking 20-25% above payroll in cost, right?
Yep.
So you got to pay attention, because you may go out and say, hey, I can afford 20 grand. Let's go hire a 20 grand employee. But you may be missing the extra 5 grand, and that 5 grand could tip the scale.
Yeah, and like you know, when you're getting into those higher expectations of revenue, you're going to end up having to hire some support staff, or you're going to be on the upper end of payroll at that point, and to retain them is going to be expensive through benefits, and so you at least have to know what you're getting yourself into.
What about, I know you're not an HR professional, but where do you dig into the payroll 1099 conversations and kind of letting businesses know, hey, maybe you're walking the line? Because I know, Nevada, it's a lot more gray. California's drawn a pretty hard line with it.
Yeah.
Do you end up having those conversations from the money side when you see kind of who's getting paid what?
Yeah, so I mean, obviously, a lot of people just want to have everyone be contractors, especially when they're first starting out. But there really is just, it's not a clear definition, but it's clear enough that you can usually make a pretty clear distinction for each person. Or if you do want to push them to one side, well, here's what you have to do. You know, you have to have them use your own tools. You have to give them more autonomy. If you want them to be a contractor, if you want them to be an employee, then have them use your tools. You can give them a lot more direction. So it's not necessarily impossible to have everyone be a contractor, but you have to be very careful, and you have to kind of give people a lot more freedom than you might necessarily want to. So those are just.
I love it. I just asked because I know on the bookkeeping side, that's always when I'm talking to the bookkeeper specifically, I always will ask that, like, well, hey, where's, like, I see the P&L and I see these things. Who are all these people? And like some of these numbers are getting big. So like, what are we actually paying them for? And is it on a per project basis? And where's the control? And like trying to dig, because I don't want you to get caught, right? Like,
Right.
and you may not be doing something that you feel is wrong, but should it come out the other way, it can hurt.
Yeah, it hurts a lot.
So let's talk, we talked taxes end of year. So let's talk exit strategies, right? So there's a lot of ways to exit a business. Well, any conversation or like, what are some things people should consider should they be on the end of that? Maybe they've done well, but COVID's kind of pushed them to the point where like they're thinking of getting out of it.
Yeah, so I think that kind of goes back to the entity structure side, but you have to have quite a lot of vision to say like, all right, I'm going to structure my entity around exit 10, 15 years from now, or 30 years from now. But I think going forward, installment sales is probably going to be a little more common if you can get them, especially with these AGI thresholds that this new tax plan sets in place. Because let's say you have a business worth $2 million. If you just get the $2 million as a lump sum and that's all capital gain, that's going to put you into those high AGI thresholds. A lot of things are going to end up taxed in ways that they don't necessarily have to. If you recognize it over 10 years, say, where a lot of people, that's what they want anyway. They want a more consistent cash flow. The person coming in definitely wants kind of that consistent cash flow if they're buying this business. So installment sale really works out for a lot of people, rather than having the person go out and get an SBA loan. You finance the loan. Worst case, you take the business back over if they can't pay you, and you can recognize that gain over 10 years. Or over the life of the loan. So it could be even longer than 10 years. But yeah, I think the installment sale is going to be pretty much the biggest conversation, how to structure that. And obviously evaluation also plays a big role. You know, you don't want to sell yourself short, and you also don't want to put yourself at a price where you're not going to find a buyer. So I think a lot of businesses end up selling to key employees. And so at that point, you just got to make sure it's fair for everyone and that everyone understands what they're getting themselves into.
Two great takeaways there. I love the creativity on the buy sell, right? Because I think that's everybody $1 million in the bank. Like it just is, right? It's that kind of American fantasy, right?
Yeah.
But that $1 million in the bank, by the time it gets to the bank, could be 500,000. So like, be careful, right? And I know we're doing, one of my clients is doing some acquisitions right now, and that's kind of how he approaches it, is like, look, I'll pay you over time because it's better for me. It has a better likelihood of the business succeeding because there's better cash flow, and it keeps you inside a tax threshold. So go talk to your CPA, because if I pay you 200 versus 400, there's a difference, right?
Yeah.
So I like that. And then, yeah, I love the idea of like, make sure you do evaluation and actually understand what the business is worth. Because I've seen it both ways, right? I've seen people undervalue, like, I could never sell my business. And then you get evaluation, you're like, there's actually value here. Or my business is worth, and then you get evaluation and you're like, yeah, okay, cool, it's not.
You gotta check your expectations.
Yeah, well, and is it sellable, right? So from a process standpoint, this is not really a finance thing, but like from a process standpoint, Do you have systems? Do you have processes? Is your documentation? Can you exit the business and the business function? Do you have a succession plan? Like all of these things matter because you can't just sell your business and walk away if your name's on the door and everybody's there because of you, right?
Yeah.
You've got to start a plan to phase yourself out. And the installment can work for that because it gives that opportunity on the purchase to take 12, 24 months of a consulting pay to phase you out of the business. So that's a good strategy as well.
Yeah, and that's why these really are 10, 15-year conversations. They're not things that should happen overnight. You shouldn't find yourself like, oh, I need to sell my business next year. You're probably going to be in trouble taking less than you should, and you're going to be able to take what you can get. You're not going to have it optimized for tax, optimized for finance, all that.
Love it. So let's ask the two final questions. What's a book someone should read, something that you find valuable, or a podcast that you recommend listening to?
I listen to mostly accounting podcasts from the business side. Yeah, I'm not sure on a book to read.
What's a good accounting podcast? Like, what's one you go to stay up to date on what's going on?
There's Cloud Accounting Podcast, just started by Blake Oliver. That one's pretty good. And yeah, a lot of them are pretty nerdy tax subjects. I don't think your audience would be that into it.
It's usually a certain type of person. It's the same with the finances. When I talk to like the financial advisors, like, here's what I listen to, and I'm like, cool. That's all another language.
Yeah. I don't know if it applies to the general audience.
So when you look at your journey, man, what's something you wish you'd done sooner, learned sooner, just some advice to yourself?
I actually stayed away from accounting for a while. I thought I was going to go into finance, and accounting's a lot cooler than I thought. And there's a lot more application than I thought, especially when you get into these, like this conversation's all been about small business and individual stuff. There's a lot more small businesses and individuals than there are public companies to work for. So I think, I would just kind of steer myself towards accounting sooner.
It's amazing how often that's the answer, no matter what industry we're talking about. It's rare that I hear someone answer and say, I wish I'd waited. Right. So it's that whole hindsight's 2020, but I love that that's your answer, because I was talking to an insurance agent, same thing. I wish I'd started sooner. Right. Especially in that industry, because you're building a book, but you're the same way. Like, you're building a book of clients, and every year you're compounding what you built the year before. So, the further you push that down, the longer it's going to take to build that base. So I love that that's your answer. And congrats on going off on your own and doing what you're doing, man. It's a cool story. I love the impact you're doing. As always, guys, go below this video. There'll be links to connect with Kevin. Make sure that you subscribe to the channel, because we're putting videos up all the time. Make sure that you reach out on all the social platforms: TikTok, Instagram, Facebook, LinkedIn. That's where all the highlight videos for this go. So if you want just the snippets, that's where they're at. Kevin, any specific platforms you want them to connect with you on, or ones that you're more engaged with?
I usually use Twitter more than any other platform. I probably will start using LinkedIn, Facebook a little more over the next year, but right now Twitter's the easiest way to get a hold of me.
Perfect. Awesome. We'll put your contact info. Thanks again for taking the time. I have a feeling we're going to have a follow-up one as we get feedback from people on other topics they want to hear about. So thanks again, man.
Thanks a lot, Devin.